All right, welcome to The Explainer. Today, we're taking something that usually brings an absolute collective groan to boardrooms across Australia. Yep, I'm talking about the dreaded not-for-profit audit, and we're going to completely transform it into a powerful tool for your organization's growth. If you're serving on a board, working as a treasurer, or maybe you're part of the finance staff for a charity, this explainer is designed exactly for you. So get ready, because we're going to fix financial governance right from the ground up. Okay, so let's set the scene here. Picture a board meeting in October. The auditor has just delivered their report on the last financial year, and suddenly, the mood in the room just totally shifts. There are matters flagged, findings, management letter points, maybe even a qualification. The treasurer is looking incredibly uncomfortable, and someone inevitably asks that question that just sits heavy in the air. How on earth did we let it get to this? I mean, you're all volunteers. You all care deeply about the mission, and everyone genuinely thought things were perfectly fine.
Well, let's dive into this because the truth is, NFP audits rarely fail because someone did something dishonest. When these audit failures happen, they're almost never about malicious intent or fraud. It's really a story about good people with bad organizational habits. It happens to stretched thin teams who are running a growing organization, but they're still using the informal kind of relaxed habits of a really small one.
So, here's our structured health check game plan for today. First, why good charities fail. Then, we'll uncover the silent size trap, diagnose 5 common audit pitfalls, look at the ultimate reporting threat, and finally, cash in on the transparency dividend. Let's get right to it.
Section 1. Why good charities fail.
You see, the real issue is almost always about small, accumulated weaknesses in how money and decisions are handled. It's like a leaky bucket. Nobody notices these tiny gaps until an independent set of eyes actually goes looking. Stretched-thin volunteers often rely on the informal processes of a small team. And hey, that works when you're tiny. But those casual habits completely break down under independent scrutiny. But the great news? Almost every common audit finding is entirely preventable with just a little bit of discipline.
Section 2. The silent size trap.
So what is this trap? Well, we call it size creep. It's basically when a charity that was comfortably small a few years ago lands a couple of new grants, runs a really successful event, and suddenly crosses a revenue threshold without anyone on the board even clocking it. Boom! You instantly have new, unbudgeted legal obligations. Your own success in revenue growth silently changes the rules of the whole game you're playing.
Let's look at how the ACNC draws clear lines here, based on rules current as of June 2026. A small charity, which is sitting under $500,000 in revenue, doesn't even need an ACNC review, and you can use either cash or accrual accounting. But when you cross into that medium tier, so $500K to under $3 million, you must have your financials reviewed or audited, and you are literally forced to use accrual accounting. Cross $3 million into large, you need a full audit. Crossing just one of these lines changes your accounting basis entirely, so you must check your size yearly.
Section 3. 5 common audit pitfalls.
All right, here's your rapid-fire map of the traps that plague well-meaning teams. 1. Poor segregation of duties. 2. Weak documentation and thin audit trails. 3. Mishandling restricted funds. 4. Cash handling weaknesses. And 5. Light board oversight. Let's unpack the biggest ones so you know exactly what to look out for.
Okay, so think about that trusted, long-serving office manager who raises the invoices, approves the payments, does the banking, and handles the reconciliations. It's super efficient, right? But to an auditor, it is a glaring control weakness. There's zero independent check on the money. Even on a tiny team, you have to split these roles up, maybe separating tasks between staff and board members so no single person controls a transaction from beginning to end. Now here's a uniquely not-for-profit failure. You have restricted funds. That's grant money that absolutely must be spent on a specific named program. Then you have general funds, which is your operational money. If you pool that restricted grant money into one giant undifferentiated income line, you are asking for trouble. You won't be able to demonstrate that the funds were used as intended. That is an instant audit finding and a potential breach of your funding agreement. You've got to track restricted funds separately from day one.
And listen to this one. We trusted the treasurer is not oversight. If directors just sit there at a meeting, nodding through the treasurer's report without asking a single question, well, that is a massive governance weakness. Visible, minuted scrutiny is legally required. The board has to prove they actually interrogated the financials.
Section 4. The ultimate reporting threat. Meet the AIS. That stands for the Annual Information Statement. This is the central, non-negotiable annual report every single registered charity must lodge with the ACNC. And for medium and large charities, those audited or reviewed financial reports we've been talking about must be attached right here. It's basically the cornerstone of your entire compliance structure.
Number 2, 2 years. That is literally all it takes. I really want to emphasize this. If you fail to lodge your AIS for just 2 years in a row, the consequences are absolutely catastrophic for your charity.
Let's see how this builds into a total nightmare domino effect. Step 1. You missed the AIS lodgement for 2 years. Maybe it was just a simple administrative diary failure because the team was swamped. Step 2. The ACNC officially revokes your charity registration. Step 3. Because you lose your registration, you instantly lose your charity tax concessions and your deductible gift recipient or DGR status, meaning donors can no longer claim tax deductions. And administrative oversight quietly dismantles your charity's entire financial foundation. And the absolute worst part, it is completely avoidable.
Finally, Section 5, the transparency dividend.
Here is the big takeaway. Good governance pays for itself. Transparency is your currency. Funders and donors increasingly demand to see clean, audited accounts before they part with their money, right? They give much more readily when they know their money is handled perfectly. When you start treating your clean audit as a fundraising credential, something you proudly put in front of every grant application and major donor, it unlocks massive growth. It stops being a cost, and it starts paying for itself.
So let's quickly summarize our wellness plan to get you there. Know your size yearly so you don't get trapped by size creep. Separate your key money rolls. Track restricted funds from day one. Keep meticulous evidence. Tighten up cash handling with dual counting. Make your board oversight highly visible in the meeting minutes. And lodge that AIS without fail. It's all about building simple, early disciplines. And hey, if you need help building this readiness, the source for today's explainer, Trinity Accounting Practice, provides virtual CFO services across the not-for-profit sector specifically designed to review and fortify these exact financial governance obligations.
We're going to wrap up our explainer today with a pretty powerful question. Is your audit a season of dread or a credential for growth? The organizations that sail through audits aren't necessarily the ones with the most resources. They're the ones that build the right foundations early on. Use what you learned today, take it back to your board, and turn your next audit into your greatest asset. Thanks for exploring this with me. Keep learning, keep growing, and I'll see you in the next explainer.